The Bank of Japan is keeping its benchmark interest rate in negative territory, and it's not alone. More central banks are adopting negative interest rates in a bid to reinvigorate their economies. So here's the situation. The Bank of Japan surprised markets in January by pushing rates below zero. With other options to stimulate the economy exhausted, more policymakers are willing to test the technique. Europe's central bank cut rates again March 10th and offered a premium to banks that borrow in order to extend more loans. Sweden and Denmark also has negative rates, and last year Switzerland moved its deposit rate below zero. In November, US Federal Reserve Chair Janet Yellen said negative rates could be, quote, on the table if things got worse here. But negative central bank rates distort the price of other securities. By February, more than $7 trillion worth of government bonds worldwide offered yields below zero. That means investors buying bonds and holding to maturity won't get all their money back. Here's the background. Negative interest rates signal traditional policy options have proved ineffective and new limits need to be explored. They punish banks that hoard cash instead of extending loans to businesses or to weaker lenders. Policymakers in both Europe and in Japan are trying to prevent a slide back into deflation or a spiral of falling prices that could derail their economic recoveries. Now here's the argument. In theory, negative interest rates should spur banks to lend and improve the economy. In practice, there's a risk that they might do more harm than good. If banks make more customers pay to hold their money, clients may hold on to the cash instead. There are also mounting worries about the way sub-zero rates squeeze bank profits. And if more central banks use negative rates as a stimulus tool, there's concern the policy might ultimately lead to a currency war of competitive devaluation.